Hi everyone, so welcome to the live stream today. Very much excited for having you on our next discussion as we continue with the ICA April 2022 examination. And we're looking at limiting factor analysis. And I want to go into that and then solve a question with you in relation to what we need to do about limiting factor analysis. Yesterday, we discussed the issue about the various principles using the marginal costing and also the principle when we use the throughput accounting. So what we want to look at. So what we want to look at is to go in and then solve some questions to see what we can do. So give us a thumbs up on the video when you join. Share the video. Also, let us reach as many students as possible joining the live stream right here as I share my screen and then bring that up with you. So yesterday we started with a discussion about limiting factor analysis, and we shared our thoughts on three key principles or three key issues there. We mentioned that number one. So what we want to look at is we mentioned that number one, you need to identify the bottleneck process. Very important. And we said the bottleneck process is simply anything that limits the organization or prevent the organization from achieving its objective in that particular case. And then, so we define what the limiting factor is or the bottleneck process is. We discussed that in much detail. Then that was the step one. And I illustrated to you using the washing machine, sorry, using a salon where we said that we will wash the hair, we dry the hair, and then we braid the hair, and then we see what we can do there. Then we saw also an example of how resources such as labor or material could be regarded as limiting factor. But most importantly, we shared our thoughts on the fact that when it comes to determining of a limiting factor, a product cannot be a limiting factor. So the product that an entity is producing cannot be a limiting factor. The service that the entity is rendering cannot be a limiting factor. It is the resources that the entity is using in order to produce the product that will be a limiting factor, and that can be either various issues such as materials, labor hours or labor availability, machine hours, machine capacity, or the process that we are using at the end of the day. So, yesterday we went through that. Then I mentioned that when it comes to the second step, which is to design an optimum production plan, there are two schools of thoughts that we need to be aware of and know about, and that is the marginal costing principle, which is the default treatment, and also we have the throughput principle, which is the alternative treatment, and we saw the various ways through which all these will be done. In case you missed that lecture, you can check the description of this video on YouTube for those of you on YouTube with us, and then you'll be able to get access to watch that particular video, the part one, so that you can watch this and it will continue like that in that case. So let's go straight up into a question we want to look at today. And just a simple question here. You can take a screenshot of it in order for you to be able to get access to it in that case. So we're going to look at this question that we have here. The requirement of the question is to calculate the optimum production plan and the maximum profit using conventional limiting factor analysis. Using conventional limiting factor analysis. Now, when the examiner asks us to use the conventional limiting factor analysis, what it means technically is that we are going to be using the marginal costing principle. Does that make sense? So we're going to be using the marginal costing principle. That is what we mean by the conventional limiting factor. Because remember, yesterday I told you that the default treatment for these things will be the issue about the marginal costing. So the examiner is saying if we use the marginal costing, we should design a production plan, number one, and then we should also calculate the maximum profit for the entity. That is number two in that case. So let me go straight up into the question. Pi Limited manufactures two products A and B. Now we see the cost sheets coming up. We have the product A, product B. We see the selling prices and all other details coming in that case. So let's look at how we can look at it. Now here, it appears that the entity has identified that the total hours available is 48,000. It means that in this question, we're not going to be the ones determining what the limiting factor is. So definitely the hours available to us is 48,000. But we want to make sure, like I told you yesterday, even if the examiner has already identified a limiting factor, it will be prudent for us to identify whether really that limiting factor is actually limited. So for that reason, the examiner said only 48,000 of the hours are available, of the machine hours are available. So let's confirm to see if really it is a limiting factor. So that is the first thing we want to do for Pi PLC. So we bring in the products. So product A, product B. We bring in the maximum demand. So the maximum demand A and B. Let's confirm to see A and B. So the maximum demand from the question is 20,000 and 10,000 respectively. So 20,000 here and then 10,000 here. All right. That's the first thing. Then we bring in the machine hours per unit, 2 hours and 1 hour. So machine hours per unit, 2 and then 1. So we multiply up, and that is going to be an amount of 40,000. Here, and then 10,000 here. So total machine hours required, if we want to make this product, is going to be 50,000 hours. But how many hours do we have available? So total machine hours available, it's 48,000. So you realize that there is a shortage here. Hence, labor is machine hours is a limiting factor. So there is a shortage of 2,000 here. For that reason, the labor hours becomes what? A limiting factor. Are you getting it? The labor hours becomes a limiting factor. So did I say labor machine hours? So therefore, machine hours is a limiting factor. Now, like I said, there was nothing in this question that requested us to do this. But anytime we are doing limiting factor analysis, even if the examiner has specifically identified that something is a limiting factor, like I told you yesterday, you must do the calculation to confirm whether really what the examiner is saying is true or not true. Because if really the entities does not have a limiting factor, then there is no need for us to go through the marginal costing principle to rank the product and do all of those things. Does that make sense? So we always have to do this workings to actually determine whether we are dealing with a limiting factor question or not. Sounds good? I see some of you guys joining. You are welcome. This is the part 2 of our discussion on short-term decisions in management accounting. Give us a thumbs up on the video, and then also comment in the chat box any questions you have for us. Like I said yesterday, management accounting is one of the critical subjects that we need to have a lot of content on here. But because we don't get a lot of engagements from it and a lot of queries from it, that is why sometimes we get ourselves limited on it. So give me a thumbs up, share the video. Let's get more engagement on the video. And that way we'll be able to produce more content like this in management accounting and not be focusing on corporate reporting and financial reporting and all those other topics all the time. So give us a thumbs up, share the video. Let's get many people watching. So now that we have finished doing that, let's set out our ranking sheet using the marginal costing principle in that particular case. So we're going to have the products coming up. So product A and product B. Then we're going to have, remember this is the traditional method, right? So with the traditional method, what is going to happen in here is that we're going to be having how is it called, the contribution. And if you remember, we said contribution equals selling price minus variable cost. Okay, SP minus VC, selling price minus variable cost. So let's see what we got here. Can slash in our currency signs. Then we bring in the selling price per unit. So from the question, the selling price respectively are 25 and 28. 25 and 28. That's the selling price respectively. Then we bring in direct material, direct labor, other variable overheads. So material cost, direct labor cost. So direct material, direct labor, and then other variable cost. So we bring them up respectively in the question. We have 8, 20, 5, 2, 7, 2. 8, 20, 5, 7, 5, 2. Am I right? 5, 2, 7, 2 rather. 5, 2, 7, 2. Now remember, you're in the marginal costing school of thought. So if you're in marginal costing, what does that mean? It means that you're going to be working with, what? The variable cost only. So if you check, we are not going to be considering the fixed cost when designing our production plan. We're not going to be touching the fixed cost. Does that make sense? We're only going to be dealing with the variable cost. So let's see what we got. We list these respectively. So let me grab my calculator here. Let me see if I can even trust this calculator. What do we have? 25, 8, 5, 7. That's 5. So you can confirm that 15. Yeah, it makes sense. 20, that will be 4. So that will be our contribution per unit. Sounds good. Then we bring in the usage per the limiting factor. So the machine hours, which is the limiting factor per unit. If you remember, the machine hours per unit is 2 and then 1. So 2 here and 1. So we divide up, and that gives us the contribution per limiting factor. So contribution per machine hours. Okay, contribution per machine hour. So you divide. Remember we said that yesterday. You're going to divide this. That's going to be 2.5 here. And that's going to be 4. Sounds good? Then we rank. When you rank, the highest is product B, and the second is product A. So it means that we will make product B first, then we'll come and make product A. Does that make sense? So that is how we use the marginal costing principle to determine which products we're going to be manufacturing or not. So now that we have the ranking available, now let's design the optimum output, which is the first aspect of the question. So the optimum production plan. What we can do is we will bring the machine hours available. So the machine hours available is 48,000 hours. Remember, that was what was given to us in the question. So we're going to be making product B. So we produce product B. Now, if you check product B uses 1 hour, we need to produce 10,000. So 1 hour, not 1 hours, 1 hour times 10,000 units. And that's going to be an amount of 10,000 hours. Then you less it to get the remaining machine hours. Okay. So the remaining machine hours, we're going to be having 38,000 hours. Sounds good. 38,000 hours. I'm seeing some comments coming in. Let me see if we can address them. Sonclair said, "Good evening. Good evening, Chitu. I hope you're doing well. Thanks for joining us." Awofe said, "I just understanding the limiting factor now. Thank you, my master. So fantastic, sir. Thank you very much, Wahid, for joining us. And thank God that you understand the thing now." Isaac Norte Okwan said, "Sir, please, which days are set aside for management accounting topics?" We really have not set aside any days. What we do is that based on the questions we have available or based on the requests we get from students, we will cover a specific topic or some topics in that case. So if you want us to do more of management accounting, put it in the comment section, the topics you would want me to cover, and also uh, give us more engagement on this video. Let's get more likes, more sharing, more thumbs up. Then that will help us to produce more of these contents. Okay. So now we have produced product B. So we will use the remaining hours to produce product A. So product A, we will use the remaining hours to get a unit of product A to make. We will bring in the remaining hours. Okay, the remaining hours. Then we divide that by the machine hours per unit. So if you look at it, we are left with 38,000 hours. And product A uses 2 hours per unit. So 38 divided by 2, that is going to be an amount of 16. Or 19 rather, sorry. 16 will be 32. So 19,000 units. So what is our production plan? Our optimum production plan is that for the A, we make 19,000 units. But for the B, we're going to make the whole 10,000 units. So that's our optimum production plan. Does that make sense? That's our optimum production plan. That is the issue about that. So for instance, if assuming, now note this very well, if assuming we had in the question a demand available or a contract, what we do is that we will produce that one first before applying the production plan. Okay, so where there is a contract, to sell or to supply a specific unit of output of a product, produce that first before applying the ranking rule. Before applying the ranking rule. So if assuming in the question for product A, for instance, we have a contract with a customer to supply, say, 5,000 units of product A, we will first produce that from the limiting factor. What will be left is what we are going to be using in that particular case. Does that make sense? So that is how we design the production plan for this. So that is the first aspect of our question, which is to calculate the optimum production plan. So this is the optimum production plan that we will make 19,000 units of A and then 10,000 units of B. Okay, so Isaac Norte said, thanks, sir. These are my suggested topics: CVP analysis, transfer pricing, NPV, payback methods, and any examinable topics. Okay, that's fine. And we even have lecture videos on these on YouTube here, so you can check the management accounting playlist on the channel, and we have lecture videos on all of these things: investment appraisal, break-even analysis, transfer pricing. We have lecture videos even already on that on the channel, but we're going to be looking at some of these things also later on and solve some questions about them, because these are critical examinable areas for management accounting. So Isaac, you can start watching some of the videos that are already on the channel. We did them just last semester also, so they are really applicable at this point. Then Messi Goma said, hello, Nhyira. Thanks for these tutorials. Very, very helpful. Be blessed. Thank you very much, Mercy. And thanks for joining us. Stay blessed as well. So now that we've calculated or arrived at the optimum production plan, we can now do the second part of the question. Okay, let's do the second part of the question. And that is, what was the second part of the question? The second part of the question is the maximum profit. So what is the maximum profit? Now stay with me carefully here. Maximum profit. So how do we go about that? We bring in our products again. So product A, product B, slash in our currency sign if we want to, or we can ignore it. Now we start with the contribution per unit. So contribution per unit. So you go to your slide here to go and pick contribution per unit. So this is contribution per unit. So you pick that up, 5 and 4. Then you bring your optimum production plan. Optimum production plan, which is 19,000 for A, 10,000 for B. So you multiply that up. We get 40,000 here. Then 19,000 times 5. That's 95,000. So you add the 2 up, and that gives you total contribution. So that will be 135,000. Does that make sense? So that's how you get your total contribution. Okay, that's how we get our total contribution. Does that make sense? So once we get our total contribution, we need to less fixed cost. Now the fixed cost, we're going to be doing workings for that. So let's do workings for that on this slide. Now be careful about the fixed cost. If you remember, as a management accounting student, one of the critical principles is that for fixed costs, they remain the same irrespective of the output level. So when you are calculating fixed costs under this, you're going to be using the budgeted units or the maximum units given in the question, not your production plan. Please be careful about this. When we are dealing with total contribution, that one you will use your production plan. But when it comes to calculating the total fixed cost, you don't use the production plan. You have to use the output given in the question. Why? Because fixed cost remains the same irrespective of the output level. So that even though product A, the entity has a plan of producing 20,000, and from the production plan we are making only 19,000, the fixed cost will still be what? Incurred. Okay, the fixed cost will still be incurred. So when it comes to calculation of the fixed cost, we're going to be using the maximum demand or the budgeted units and not our units for the production plan. I hope that makes sense very well. So we're going to slash in our products. Again, A and B. We can bring in the fixed cost per unit. So fixed cost per unit is going to be an amount of 3 and 2 respectively. Then we'll bring in the maximum unit or the maximum demand in units. And that's going to be an amount of 20,000 and 10,000. Not the design plan, not the production plan. So we multiply up, and that becomes 20,000 here and 60,000 here. So our total fixed cost, it's going to be $80,000. Does that make sense? $80,000. So that's how we calculate the total fixed cost for this particular one. Like I said, when you're dealing with fixed costs, you don't use your production plan. All you'd use is you're going to be using the maximum units available. So now that we have that as 80,000, we bring it back to our profit. So we less fixed cost from the workings, 80,000. And that gives us our answer of 55,000 as the maximum profit. Any question? So that is how we deal with the conventional approach for this one. Any questions? That's how we deal with the conventional approach. Any questions for me? Now, what if the same question, but this time around we are using throughput accounting? How will it be like? The same question, but this time around we are using throughput accounting. How will it be like? So let's go and look at a concept if we are using throughput. If we are using throughput. So if we are going with throughput, now remember this is not in the question. Remember throughput is selling price minus direct material cost. Because we said in throughput, in the short term, direct material cost is the only variable cost. All other costs are considered as what? Fixed or factory cost in that case. So products A and B, bring it in our selling price. So if we check our selling prices respectively, 25 and 20, then we're going to less the material cost. Let's go pick it up. And that is 8 and 20. Sorry. Yeah, 8 and 20. Oh, am I right on that? 8 and 20. This is 28. So you less that, and that gives you your throughput per unit. And this is going to be 8, and this is going to be 12, 17. There. Then we bring the machine hours per unit. If you remember, the machine hours is 2 and 1, I guess. Yeah. We divide, and that gives us the throughput per machine hours. So 17 divided by 2 will be 8.5. And this will be 8. Then we rank. So this is number 1. This is number 2. So you see that when we were using the conventional approach, marginal costing, we ranked the product and B was having the highest contribution. B was having the highest contribution. But if we use throughput, A rather is having what? The highest contribution. That's the idea. So now that we have this, we can design the optimum production plan. By bringing in the machine hours available. So the machine hours available still 48,000. But this time around, we will produce A because A has the highest returns or throughput per limiting factor. Now the question is, why are we making first the one with the highest throughput per limiting factor? Throughput, like in throughput accounting, our objective is to maximize throughput. Okay, that's our objective, which we want to maximize throughput. So if we want to maximize throughput, then that is why we divide by the limiting factor. So the one that gives us the highest returns for the usage of our limiting factor, we will make it in-house. Then the one that gives us lowest returns for the usage of our limiting factor probably will be outsourced and bought at a cheaper price at the end of the day and brought into the company for the period under review. Does that make sense? So if we make A, we are making 20,000 of A, but A needs 2 hours. And so that's going to be 40,000. Take it out. And we get the remaining hours. And that's 8,000. So from here, for product B, we can produce 8,000, obviously. It will be 8,000 over 1. That's going to be 8,000 units. So what is our production plan? Very simple. So with product A, we make the whole 20,000. But B, we can make only 8,000. So that even though we need 10,000, we can only make 8,000 from this production plan. Does that make sense? So based on this, we can then get our profit for the period under review. So let's determine the profit for this one real quick. So optimum profit. Now, just like we did in the marginal costing, similar thing will be done here. So product A and B. This time around, we're going to start with the throughput. We're going to start with the throughput, 17 and 8. We bring it up. Then we multiply that by the optimum production plan. And we are making how many? All of A and 8,000 of B. So 20,000 and 8,000. So you multiply up to give us the total throughput. So 8 is 64. So that should be 64,000. Then 17 by 20 by 10 is 170. That will be 340. And that will be 340 there. So 340,000. So you add the two up to give us the total throughput. So our total throughput 340 plus 64. That will be 404 if my memory serves me right. So 404,000. Sounds good? So that is the total throughput. But that's not what we are interested in. Really, we are interested in the profit. So let me put that well, slash in a currency sign here. And let me say total throughput. 404,000. Okay. Then we'll less factory cost. Remember, in throughput, our interest is factory cost. And here we're going to be doing the workings for the factory cost. Remember, in throughput, we are assuming that our only variable cost is direct material cost. So all other costs are treated as factory cost. So if we go back to the question, you realize that all other costs this time around, apart from the direct material, we're going to bundle all the other ones. So labor, other variable overheads, these three guys will add up as factory cost. So this is 12 plus 3. And so that's going to be 15 here. That's going to be 6 here. Okay, so the factory cost per unit is 15 and then 6 in that case. So you bring in the products A and B. So factory cost per unit, 15 and 8. Then we bring the maximum demand. 20,000, 10,000, you multiply up. 10, 8, 80,000. 15 by 10, that will be 150, 300,000. There. So the total factory cost is going to be 380,000. Are you getting the idea? 380,000. So we're going to less that from here. And then we get our net profit. And that'll be 24,000. That's it. So that is the difference between how we deal with this thing in the marginal costing. So under marginal costing, we got a profit of how much? We got a profit of 55,000. But if we use throughput, we are getting a profit of just 24,000 in that case. So that's the difference between the throughput accounting and the marginal costing approach. And that is what we mean by limiting factor analysis. That's what we mean by limiting factor analysis. Any questions, please? Any questions? Any questions? Wahid said, so getting better. Said, okay, that's fine. Any questions? So that's the idea. So when we talk about limiting factor, this is what we mean. This is what we mean about that. Any questions, please? Any questions? Now remember that you can join my Telegram channel. So if you're on Telegram, connect with me on Telegram and check out my channel on Telegram to subscribe, because we're going to be doing some exclusive Q&A sessions on Telegram in the course of from next week going. So make sure you subscribe to my Telegram channel at Nhyira Premium, the same name here. So just search for Nhyira Premium on Telegram, and then you'll find my channel and be able to subscribe to the channel, because we're going to be doing some live Q&A sessions there on Telegram to really help you to prepare well for your examination, and most importantly, pass the exams in that case. So make a date and join me on Telegram as we do some Q&A sessions there. Okay, as we do some Q&A sessions there. Okay, so that's it about limiting factor analysis from the marginal costing principle and the absorption costing. Did I say absorption costing? From marginal costing principle and then the throughput principle. Any questions for me, please? Any questions? Donald Jesri said, so under throughput, there is no over or under absorption of, no. There is nothing like over or under absorption of overheads here. There is nothing. Under or over absorption works only when we are dealing with, how do we call it? Absorption costing. But in throughput, we don't over absorb overheads or under absorb overheads in throughput. It's just a simple thing and we go away with it, Donald. Ibrahim Kondewa said, "Hi, Mr. NP. I came late from Sierra Leone. Okay, so welcome. We are looking at limiting factor analysis. This is the part two. In case you missed the part one, you could watch that on the on the channel. Just check the management accounting playlist or check the description of this very video or of this video. You should be able to get a part one to watch. In that case, you should be able to get a part one to watch. So that's it about limiting factor analysis, and that is what I wanted to bring to your knowledge or to your notice about when it comes to management accounting. Like I mentioned, I would love to do a lot of topics on management accounting. Okay, the break-even analysis or cost volume analysis, net present value, make or buy, relevant costing analysis. These are all key topics. Variance analysis, transfer pricing. Budgeting and budgetary control. I would love to cover some of these topics on the live stream, but the truth of the matter is that, like I said earlier, we do not get engagement on the management accounting videos the way we get on the financial reporting and the management accounting video. And this is our community, so I have to tell you why certain videos we do a lot. So sometimes people are like, Nhyira, every time you're doing financial reporting, corporate reporting, accounting standards. Yes, because we get a lot of engagement from these contents than from the management accounting content. So the number of people who join the live stream, the engagement you have, the number of sharing and all that, that's it. So if you want more of the MA management accounting content, give us a thumbs up on the video. Make sure that you share the video. Let's reach many people. If we get more engagement on these videos, then certainly we have no other option but to make sure that we produce more content to cover some of these topics. Are you getting it? So that is it. So for those of you doing management accounting, push the video. Let's get more engagement on it, because if we do the video and we don't get a lot of people engaging with it or watching it, then it will be not too productive, like if there are other videos that people want to watch. So for those of you doing MA, make sure you push the video. Let's together get a lot of people engaged. Then we will be able to make more of these content so we can assist you. All right. For FR and CR people, I mean, they do their best in that particular case. So MA, let's do more. And then if there are any other topics also, you can drop them in the comment section or in the chat, and I'm going to be checking all of them out as we continue in that case. Remember to subscribe to my Telegram channel. So I'm on Telegram, Nhyira Premium. We'll be doing some live Q&A sessions there. So make sure you connect with me there. Okay, so Donald said, thank you, sir. Noted. All right, you're welcome. So that's it about that. Thank you very much for joining me on the live stream. Remember to follow me on Instagram, subscribe to my channel on Telegram as well. Let's stay connected because we want to see how we can better help you answer some questions that you have for us. So make sure you follow me on Instagram. All our discussion, things to be shared on, will be posted on my Instagram page and also on my Telegram channel. So make sure you subscribe to my Telegram channel as well and get connected. Thank you very much. I'll catch you same time tomorrow at 4:30 p.m. as we continue with our discussion towards the ICAG April 2022 examination and see what we can do in that case. So stay safe, and thanks you guys for the thumbs up and then the likes in that particular case. Eric Ahia the key on Facebook. Thanks for that. And then those of you who share the video also, thank you very much. I'll catch you again tomorrow as we continue with our discussion. Bye bye.